In today's episode, we'll talk about three interesting stories. In the first story, I'll talk about how SEBI has recently banned Axis Capital from doing debt merchant banking. In the second story for the day, I'll talk about how China is slowly getting older and what it means for India. And in the third and final story of the day, I'll continue from yesterday's story on India's rising trade deficit. Welcome to the Daily Brief Show by Zerodha, where our goal is to give you news in a way that is one level deeper as compared to traditional news channels. I'm your host Anurag Bansal. Today is Monday, the 23rd of September. So let's begin. SEBI recently made a very big decision. They barred Axis Capital Limited or ACL from doing debt merchant banking. Now you might be wondering, what does a company like Axis Capital really do? See, they are what's called a merchant banker. Basically, they help companies raise money by selling securities like bonds or shares. Think of them like financial mediators in a way. They do the paperwork, make connections, and ensure everything goes smoothly. Now, all of that sounds fair and legitimate, right? So, what made SEBI take such a decision against them? Look, this happened because in a way ACL messed up. They did not just stick to their job of arranging deals. They also started to offer to cover these losses if things went south. Now, this entire drama kicked off with a report titled "Is Axis Capital an Investment Bank or a Hedge Fund?" This was published on January 16 this year by Himindra Kishan Hazari, who is a SEBI registered research analyst. Now, this report raised eyebrows by pointing out some very risky moves ACL was making. SEBI took note and decided to dig deeper into one of those deals. Now, the spotlight was on Sojo Infotel, which is a small private tech consultancy that needed to raise some cash. So they issued non-convertible debentures or NCDs, which are basically corporate bonds, and raised around 260 crore rupees. And guess who helped them sell these bonds? Well, ACL. See, here is where things get messy now. ACL not just helped arrange the deal, but they also promised to step in if Sojo could not pay back the bondholders. And that is where things went off track for them. See, the thing is, ACL is not a bank, so they're technically not supposed to guarantee loans or act like a lender. Merchant bankers take on market risk, like when they sell securities that may not get fully subscribed, but they are not supposed to take on credit risk. That is a bank's job, but ACL went all in and promised to pay back bondholders if Soju could not do this. This was a major regulatory problem. But what exactly went wrong here, you might be wondering? See, Sojo used the money from the bonds in order to buy shares in Lava International. I hope you remember Lava, by the way. They were once a very big name in the Indian mobile market before smartphones took over. At one point, Lava phones were everywhere. But it turns out that the people running Sojo also owned 80% of Lava. So in a way, this whole bond deal was like moving money within the Lava family itself. But things did not go according to plan for them, obviously. Sojo could not pay back the bondholders when the debt was due. And that is when ACL's guarantee came back to bite them in a way. Instead of just arranging the deal, ACL had to step in and pay up 166 crore rupees to cover Sojo's debt. And that is when SEBI, which is India's market watchdog, stepped in. They saw that ACL had overstepped its role by providing guarantees, which is something only banks should be doing. And that was not just one deal. SEBI also found out that ACL had done this in a few other private bond deals as well, where they acted as both an arranger and a guarantor and blurred the lines between merchant banking and commercial banking. To make things even worse in this case, Lava, which is the company whose shares were at the heart of this deal, failed to go public in time. Lava's IPO was supposed to raise the money needed in order to pay back the bondholders. But when the IPO did not happen, Sojo's bonds were left in trouble. And here's the thing, when things did not work out, Sojo's promoters sold off some Lava shares for a partial repayment. But again, that was not enough as well. Sojo missed the deadline to pay the rest of the bonds, and that is where SEBI came down hard on ACL because ACL had guaranteed the entire thing. SEBI then noticed how ACL had taken on both roles, a merchant banker and in a way a credit backstop, and they realized how dangerous this could be for the financial markets if it was left unchecked. So SEBI hit ACL with the ban and stopped them from taking on any new debt deals. Plus, SEBI also announced that they're looking into Axis Bank, which is ACL's parent company, because this whole mess could have bigger risks for the banking sector. SEBI also soon might get the RBI involved in this because let's face it, when you're paying with credit guarantees, you're essentially in a way playing with fire. Moving on to the second story of the day, let's talk about how China is getting older. Imagine working your whole life looking forward to the day you can finally retire and relax, but to only find out that just as you're about to retire, the government has increased the retirement age. That is exactly what is happening in China right now. China has decided to raise its retirement age. Starting next year, men will retire at 63 instead of 60, and for women, it is going to be somewhere between 55 and 58 depending on their jobs. Now, the question is, why is China doing this? Look, it's not just about squeezing in a few more years of the working population. It is actually tied to a much bigger problem. China's population is shrinking, and this could end up affecting many economies around the world, including that of India. Let me explain what is happening. See, China is currently going through a massive demographic crisis. For decades, its population was rising, but fast forward to today, its population has actually started to shrink. Earlier, the expectation was that the population would peak in 2030, but by 2022 itself, it became clear that the peak had already happened. Last year, China's population shrank by 850,000 people, and the decline trend is just getting started for them. So, why is this happening, you might be wondering? Look, there are a few reasons. First, as more Chinese women joined the workforce, they started to believe that it made less sense for them to have children. This is because of a massive cultural shift where women are choosing to focus on their careers and personal goals instead of starting families. But it's not just about changing lifestyles. The government has also played a big part here. From 1980 to 2016, China ran a one-child policy in the hope of controlling their population growth. Now, even though this helped control their population growth rate, it was way too effective. And that ended up creating new problems for China. Because fewer babies were born every year, there were fewer younger people to replace the older generation that was soon going to retire. You see where this is going? The scary part is that by 2035, China is expected to have 40 crore people over the age of 60. And to give you an idea of how big this number is, it is more than the entire population of US today. Now, this means many older people will retire in China in the next few years without enough youngsters to fill in their shoes. And as you can imagine, this situation will put immense pressure on the Chinese economy and will also nudge the world to keep reducing its dependence on China, which could in some ways be a blessing for India. Another huge problem here is with so many people retiring in the next 10 years, who will even pay for their pensions? China's pension system is already under serious strain, and some experts even predict that the country's pension fund might completely run out of money by 2035. By the way, as a side note, this pension situation is not just a problem in China. Countries like the US and Japan are also dealing with very similar issues as their populations grow older, with fewer youngsters filling in their shoes. Now, back to the story. All of this presents a very big opportunity for India. Today, India has a population with an average age of just 28 years. So, as China's workforce shrinks, India, with its younger population, can potentially step in and take advantage of this situation to attract businesses and investments that are looking for skilled and youthful labor. But that is an ideal situation in a way. In reality, to truly take advantage of the opportunity and compete against a giant like China, we need to seriously improve our capacity and capability at speed and at scale. Today, India is well behind China in most of these aspects. But coming back to China's population problems, pension is just one small part of the story. The bigger issue is how an aging population will affect the economy as a whole. When people retire, they stop working. This means they stop contributing to the country's output. Fewer workers means less stuff gets made, and that also means that the economy can start to shrink very quickly. On top of that, fewer people also means less consumption. China already struggles with low domestic demand, as I had discussed in some recent episodes, and this imbalanced population situation will only make things worse for them. For China's economy, growth had dropped from 10.6% in 2010 to 6.1% in 2019. So if they don't figure out something very quickly, matters could worsen for them. Some experts predict that by 2035, China's economic growth could fall to just 1% per year, which is very similar to what happened to Japan from 1991 to 2001 when their economy hit a wall as its population aged. But the big question here is there a solution, and what is China doing in order to fix this? See, first, China is trying to boost their birth rates once again. They have gone from having a one-child policy to allowing 2 children and now even 3 children per family. But this, as a matter of fact, is not solving the problem. Having kids is an expensive deal. So even with relaxed policies, many families still stick to just one child, and in some cases, no children. Another thing China is doing in order to solve this problem is raising the retirement age, as I mentioned earlier. Their idea is to keep people in the workforce for longer so that they can continue contributing to the economy. But again, raising the retirement age has its own challenges, especially in a country where a lot of people still do physically demanding jobs. Imagine asking a 60-year-old construction worker to keep going on until they're 63 or 65. It's not an easy task at all, right? Now, China probably recognizes these issues at some level, so they're trying to do one more thing, which is increasing productivity. The idea here is even though China's workforce may be shrinking, if the remaining workers can somehow get more done in the same amount of time, it could offset all the impacts of an aging population. Other countries like Japan have tried this strategy in the past and have seen a bit of a mixed result. But for China, this seems to be one of the very few options they have left now. Closer to home in India, this could serve as a brilliant example of what not to do while trying to control the population. Avoiding extreme measures like the one child policy and instead focusing on balanced growth could help our country avoid a very similar demographic crisis a few years later. If you think about it, everything that India has achieved as a nation over the last 30 years or so has been because of our people and favorable demographics. Whatever happens with that population in the next 30 to 40 years will be a major decider of where our economy heads in the next few years. Moving on to the final story of the day, let's talk about whether or not we are exporting enough. If you remember on Friday, I had spoken about India's big merchandise trade deficit. I'd also discussed how even though the government has been pushing very hard to boost manufacturing for over a decade now, we are still not where we needed to be. India has a long way to go before we can call ourselves a global manufacturing powerhouse. Let me break things down a little further today. See, exports are not a huge part of India's economy right now. Our exports to GDP ratio is just about 22%, which is much lower than some other countries. And while we are trying to attract manufacturing businesses away from China, we're up against some very tough competition. Countries like Vietnam, Thailand, and Malaysia focus more on exports than we do. So we are up against some serious heavyweights in the world, and we also have our own problems to fix here. There is simply no single silver bullet solution to our problems, and our only option is to probably patiently keep solving as many problems as possible, hoping that it'll be enough. Let's take shipping for an instance. Even if you're a top-notch Indian manufacturer who's done everything right, this means even if your product is as good or even better than what your Chinese or Southeast Asian rivals are offering, you might still lose export orders. Why, you might wonder? See, that is because even if you nail your part of the job, once the goods hit the port, a ton of things can go wrong. First, Indian ports are infamous for being congested. The infrastructure and human capital is not enough to keep up with the demand. So once your shipment reaches the port, it can sit there for 2 to 3 days before it is picked up, which is not great. The second thing is that in order to export goods, you need containers. But the thing is, India does not have enough space to store empty containers. So when is the time to export, there is often a shortage, which means delays. The third problem is that people are just not able to find ships. See, big global shipping companies are based outside India. Sometimes during a shipping crunch, they tend to skip Indian ports altogether. And here is the shocking part. India has just one company that does container shipping, the Shipping Corporation of India, or the SCI. And guess how many container ships it owns? Just two. The next problem is that many Indian ports are too shallow to handle the world's biggest ships. So we end up using smaller feeder ships to take our goods to bigger ports in places like Sri Lanka, Dubai, or Singapore. Now this takes extra time and also makes our exports more expensive. The other problem is sky-high costs. That is because Indian ships can only handle about 5% of our country's shipping demand. We still heavily rely on foreign ships. And these foreign shippers charge us more because stopping at an Indian port means extra planning and also clearances. All of this drives up costs. And India spends a whopping 109 billion US dollars every single year on just shipping. The sixth problem is paying to wait. See, while your goods sit at the port waiting to be shipped, you've got to store them somewhere, right? And guess what? Storage is not at all cheap. Even though things are better than they were 10 years ago now, we are still way behind global standards. Indian manufacturers are at a huge disadvantage. And even if they do everything right, just getting their goods shipped takes more time and money than it does for international competitors. And Indian exporters are not quite happy with this for obvious reasons. Exports have dropped for 2 months straight now, and August saw the biggest dip in over 1 year. A major factor is shipping costs here. In August, freight costs were 70% higher than they were in the previous year. Now, obviously, some of this is beyond India's control. Geopolitical issues like tensions in the Middle East and the US China trade war have worsened things. But when you combine these outside factors with our existing problems, no wonder India does not look like the best place to do business in a way. But there is still some good news. This drop in exports has finally nudged the government to take some action. Commerce Minister Piyush Goyal recently met key officials and industry representatives, and they've announced many new measures. Here is a quick overview. First, 5 new ships. First, SCI will build 5 second-hand container ships, which should help boost its capacity. Second, while buying new ships takes time, SCI is also planning to charter enough ships in order to handle the extra 9,000 containers in the meantime. Third, for 90 days, you can now store containers for free at the Railway Board and Container Corporation stockyards. Even after that, storage fees will be cut in half. Fourth, the cost of loading, unloading, storing, and handling goods at ports is being slashed now. Fifth, the custom boards will now screen 2 container ships at once, which will speed up the process. Now, the question is, will these measures solve all our shipping problems? Of course not. Let me quote the popular poet Robert Frost. We've got miles to go before we sleep. See, expanding SCI is just a temporary fix for us. In the long term, we definitely need more Indian shipping containers and a major port revamp. India is working on revamping its old shipping laws and pushing other reforms that could make things smoother in the future. But until all that happens, these structural issues will continue to be problematic. But that said, these new measures are definitely a step in the right direction. If India is going to become a manufacturing-driven economy, it is going to take a lot of small improvements like these. For now, at least, things look a little brighter for Indian exporters. Moving on to the last section of the day, which is the mini tidbits of news. First, Securities Transaction Tax Revenue or STT collections for FY 23-24 exceeded 26,000 crores in just over 5 months, and they have now reached 70% of the annual target. Second, lead prices are expected to rise due to increasing demand from the EV and energy storage sectors. However, global supply is projected to grow, which could ease prices in 2024 and 2025, according to the World Bank. Third, the Bank of England maintained its interest rates at 5% despite inflation ticking up to 2.2% in July. Concerns over persistent wage and service cost growth have kept the central bank cautious. That's all the news and stories I have for you today. I hope you found value in today's episode. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.